Okay, so today's video is the 7th in our series that we've entitled Huge Options Trading Blunders. We've decided to produce this series for traders who are serious about trading options for a living and badly want to succeed, but they keep getting sidetracked by pursuing strategies with huge flaws in them instead of taking the proper steps to excel and improve as an options trader. I'm the head trader of SMB Capital's Options Trading Desk, and I can tell you from many years of experience that I've seen every one of the mistakes that we're describing in these videos, and some of them I fell for myself when I first started trading. They're real. And if you're serious about trading for a living, you really need to pay close attention to these videos so that you can avoid serious problems and unnecessary detours in your trading journey. So if you're committed to trading full-time as an options trader, then I urge you to watch this video and the rest of the videos in this series so that you don't fall by the wayside like so many aspiring traders who don't want to spend the time to learn the actual truth about the rewards and challenges of options trading and the skills you'll need to develop to succeed. We want you to take a realistic path to your trading goals, which are attainable if you're serious and willing to put in the work to succeed. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's Options Trading Desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so today we're going to be looking at Options Trading Blunder number 7 in our series on options misconceptions and huge mistakes that you can make in your journey towards becoming a full-time options trader. So to understand Options Trading Blunder number 7, I need to make sure that you are familiar with the basics of how index options work. And if you know something about options, don't worry, this is going to be quick, and then we're going to jump into the main part of the lesson. Now, almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index. But what you can do is to get paid in cash, $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if an index is trading at 1400 and you buy the 1410 call, if the index goes to 1415, you would receive $500 in your account. If the index closes at 1410 or lower, your call expires worthless. On the other side of the ledger, if you buy a 1385 put and the market sells off to 1375, you'd make $1,000. But if the market just sold off to 1385 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will also allow you to sell options. And your broker will allow you to put together combinations of options, in other words, options strategies that involve both short and long options purchased in a way that is advantageous to you as a trader. Okay, so now armed with that knowledge, let's dig into Options Blunder number 7. So one of the core strategies for options traders is known as the Strangle. Yes, I know that's a gruesome name, and lots of options trading strategies have these strange names, but suffice it to say that the Strangle is at the core of many of the top strategies for professional options traders. So a Strangle is actually a very simple trade on its surface. For example, let's say that someone was interested in trading a Strangle on the NDX index. So on this particular day in August of 2019, suppose that you decided that you wanted to make a straddle trade on the NDX, which is the NASDAQ 100 index, by the way. Companies like Apple, Amazon, Google, Microsoft, and other top tech names are the major components of the NASDAQ 100 index, and it's a very popular trading vehicle for options income traders. Now, on this particular day, the NDX index was trading at 79.66, as you can see. So what some traders like to do is sell a call way above the price that the index is selling at, and at the same time sell a put way below the money. We can discuss another time how you would make the decision as to which short call and short put to place. But for now, let's just say that this trader decided to sell the call for options expiring in 29 days at about 350 points above the index price, up at 83.25 for $14.80. And at the same time, sell a put 600 points below the market price of NDX down at 73.50 for a price of $23.60. Now, I'd also like you to notice that your broker would require you to put up $83,000 in capital to make this trade. Please make note of that because that's going to be a very important fact shortly. Now, putting this into perspective, as you can see on that day, the 83.25 strike price is well above the all-time highs of the NDX, and furthermore, the index had not been as low as 73.50 strike for several months. So the trader might be thinking, hey, there's a pretty good chance the index will not rally more than 350 points above its all-time highs, nor is it likely to drop 600 points from here to a price that it hasn't been to in a few months over the next 25 days. So if the trader believes that the NDX will stay somewhere inside that range between the short put at 73.50 and the short call at 83.25, then the strangle would be a very logical trade for him to make. Now, we're about to move forward to the day that these options expire on August 30th. But before we get into that, which will explain how this trade worked out and more importantly, why this trader completely missed the opportunity to make a much better trade, I wanted to let you know that there really are sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running right now. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just go ahead on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now moving forward to expiration day on August 30th, as you can see, the NDX index closed at 76.77. Now, being 2 in the afternoon on this day and just a few hours from when the options expire, the call option has dropped from $14.80 down to 25 cents because now the market is close to 600 points from that call and there's only a few hours left for it to get there. So that obviously has very little value. And the put has actually dropped to 17 cents because the market, again, in less than 2 hours has to drop more than 300 points for that put to have any value at all. Now, what that means is that if you wanted to close the trade at that moment and pocket your profits, those profits would have come in at $39.48. So let's analyze why that's the case. Well, when we first entered the trade, we received cash into our account for selling the call and the put, as you can see. So for the call, we received $14.80, but that represents $100 per point. So you multiply that by 100 and you see that we received $14.80 for the call. And for the put, the same calculation. You multiply the $25.30 we received by 100, and you'll see that we received $2,530 for that call. Now, to close the trade, we're going to need to buy back the call and the put that we sold to close out the trade. So that's not going to cost us much because the calls dropped to 25 cents, so that would cost us only $25. And the put has dropped to 70 cents, so that will only cost us $17. And so when you do the math, the total profit comes to $3,968 on the transaction. Okay, so you're probably thinking, how is that exactly an options trading blunder if you've made more than $3,900? And the answer is, it's a blunder because you could have made so much more money out of the trade with half the capital and half the risk if you were willing to buy long options to protect your short options. You see, that formation that we just discussed, selling the Strangle, well, you'll recall that I told you that we'll need over $83,000 for that trade. And you may have been wondering, hey, if we just sell one call and one put, why do we need $83,000 in capital for that trade? And the answer is that even though we sold just a one lot Strangle, the risk, once the market gets past those options, if that were to happen, is substantial. Why? Because if the market were to really sell off very hard, or if it were to really rally very hard, then the risk is enormous because you have to keep paying $100 more per point of the index, as we discussed before, regardless of how far that index goes. And so your broker recognizes that you're basically taking unlimited risk, and they're going to require you to put up a huge amount of capital to make sure that you've got enough money in your account to pay off on that option in an extreme market move. Well, as it turns out, given that you've made about $3,900 on that trade and your broker margined you about $83,000 on the trade, your return on the trade was actually 4.7%. Well, you're probably saying, that's not bad at all for a month, but you're missing when you say that there was a much safer way to construct the trade where your potential for return is much greater. But it involves you buying a long call above your short call and a long put below your short put into what is known in the options world as an iron condor. Okay, so let's take a look at what it would have meant to our position if we had bought a long call directly above the short call and a long put directly below the short put. Okay, so now let's carefully break down what's going on here. You see, just like before, we're selling that 83.25 call and the 73.50 puts like we showed you before, but this time we're buying the 38.50 call and also buying the 73.25 puts. Now let's break down what that means. Well, just like before, we're going to receive $14.80 for selling the call and $25.30 for selling the put. But this time we're spending $1,175 to buy the call right above the short call, the 83.50 call, and we're also spending $23.60 on that long put at 73.25. And if you net it all down, you get a credit of $475. So you're probably saying to yourself, how dumb is that? Why would you spend so much money and end up with a little more than 10% of the cash flow you were getting if you didn't buy the long call and the long put? And the answer is that you're asking that question because you have fallen into options trading blunder number 7. I'm not going to waste my money buying long options to protect my short options. Now, why am I saying that receiving less cash is an options trading blunder? The most important reason is that with a short Strangle, you've got unlimited risk, as we discussed. But with an iron condor, there's an absolute limit to how much you can lose. And in fact, your broker knows that, and that's why the broker margins you so much less. In fact, in these two examples, as you can see, your broker would have margined your account 83.6 for the short Strangles, as we mentioned before, but for the iron condor, he would have only margined you $2,025. And why is he margining you so much less? Well, that's because the long put protects the short put. So that if the market really tanks, the long put starts having value, and it is an increasing value at that point at about the same rate as the short put is costing you. So the long put effectively puts a stop on your trade. It stops the bleeding if the market really takes off to the downside. And the same for that long call. If the market blows past your short call to the upside, then in 25 points, your long call will kick in, and that will stop the bleeding on the short call. And so your broker knows all this and only charges you $2,025 per option because you have built-in protection into your trade, and the broker knows how that's going to work. Well, this fact is actually huge. Why? Because the return on your iron condor is way higher than the return on your short Strangle if you think about it. Why? Well, let's take a look at an example, and this will become quite clear to you. So let's say that on the same day that we entered into the one lot short Strangle trade, suppose that instead we entered into 20 iron condors with the same short strikes, 83.25 on the calls and 73.50 on the puts like last time. But this time we buy the protective call and puts, just like we showed you on that one lot example. except this time we execute 20 of them. Now, let's break down what happens in this case. Well, as you can see from the calculation, if you get $475 for just one of those Condors, you get $9,500 for 20 of them. You get 20 times the cash from the options you sold, although you pay 20 times that amount for the options you buy, incidentally. Yet, and here's the great part, you're using less than half of the capital. And so if we move forward to the day they expire, you can see that the short calls and the short puts have shrunk to almost no value because, again, the NDX is trading at 76.77, and those short calls and those short puts are just too far away from the market for them to be in any real danger with 2 hours left before they expire. And the same is true for the protective long call above the short call and the protective long put below that. They're even farther from the market, and so obviously they're going to have even less value. So if we just go ahead and close the Iron Condor at that point, by the time you actually get it executed, it will look like this. You'll have to pay to close the two short options, and you'll receive cash back from selling the long options, and the result is that you'll end up with $9,360 profit from the whole transaction. Now, just to drive this point home, let's take a look at the comparison between these two approaches. Using the single short Strangle, we make a little less than $4,000 on more than $83,000 in capital. But with the 20-lot Iron Condor, with around $40,000 of capital, less than half of the amount your broker will require for the one short Strangle, you'd make $9,300. That's a return of 23% versus about 5% with half the risk. If that isn't enough reason to convince you that this is a blunder, then you should consider one more thing, and that is that the short Strangle has unlimited risk. Unlimited. That's a lot. Infinity's a lot, okay? And so even though your broker will margin you a finite amount, $83,000, it could theoretically get worse than that. Yes, you will spend money on the long call and money on the long put, but the results of using these longs is so dramatic on your capital utilization that it's not even close, as I hope this example made clear. So please don't fall for options blunder number 7. You obviously get a much higher return with protected positions like Iron Condors, as opposed to what are known as naked positions like Strangles with unlimited risk and massive capital requirements. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please, don't forget to click on the subscribe button right now so you won't miss the next episode of Huge Options Trading Blunders and all the other free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.